Okay. Good morning, guys. See, yesterday one question I gave you to try at home. Did you all solve that question? So let's discuss that question. Okay. See, one question which I dictated you yesterday. In that question, capital gain computation we are supposed to do for two associates. Number one, Mr. Mehta and Mr. Gopal. So I'll write down here. Okay. Computation of what? Capital gains. Mr. Mehta Mr. Gopal. Now, capital asset transferred. Which capital asset is transferred? Trademark. Mr. Mehta is transferring trademark and Gopal is also transferring the same asset. But for Mehta it was self-generated and for Gopal it was acquired. Right now? Date of acquisition. Date of acquisition. When Mehta started business? 1980. And when Mehta transferred? 1912-25. When Gopal acquired? 1912-25 only, no? And when Gopal transferred? 9th March 2026. Just a second, guys. So, in both the cases, you have to now check period of holding. For him, the period of holding is more than 24 months, and here the period of holding is less than 24 months, less than equal to, and here and here. This is a long-term capital asset, and this is a short-term capital asset. Okay. So these are some basic things. So now how to calculate capital gains? Come on, tell me. Very good. Full value of consideration minus transfer expenses. You get net consideration minus cost of acquisition minus cost of improvement. Okay. So how much full value of consideration Mehta was getting? 1 crore 50 lakhs. And Gopal was getting 1 crore 80 lakhs, no? What is the transfer expense in the hands of Mehta? How come 1 lakh? It was 2 lakh, no? But half was, yes, equally shared, no? So 1 lakh here. And how much Gopal incurred? Gopal. No. When Gopal transferred the asset to Tanmay, at that time, when Mr. Gopal transferred the asset to Mr. Tanmay, at that time, how much he incurred? How come nil? Because entire expenditure was borne by. So at the time of transfer, Mr. Gopal is not incurring any capital expenditure. Yes or no? Sorry, not incurring any transfer expenditure. Yes or no? But that 1 lakh, half amount which is incurred by Gopal at the time of acquisition will increase the cost of acquisition. Getting my point what I am trying to tell you? So now, see, net consideration here will be 1 crore 49 lakhs. Okay. Here it will be 1 crore 80 lakhs. And cost of acquisition for Mehta will be nil. Because for him it was self-generated. Yes or no? Cost of improvement will also be nil. But now if you will say Gopal had acquired for how much? 1 crore 50 lakhs, no? But at the time of acquisition, Gopal had also paid 1 lakh rupees. So that 1 lakh will be added to the cost in the hands of Gopal. So see, when Mehta sold, 2 lakh rupees of expenses were incurred. Yes or no? But out of that, half was borne by Mehta and half was borne by Gopal. So Gopal is acquiring, Mehta is transferring. So whenever the Gopal will incur the amount at the time of acquisition, that will be added to his cost, no? So his cost will not be 1 crore 50 lakh, it will become 1 crore 51 lakhs. Got it? How many of you committed mistake here? And 1 lakh you took there also, no? Right, no? Other's wife, my wife. How come? I gave you example also yesterday. So now tell me, how much will be this? 1 crore 49 lakhs. And this will be 29 lakhs. This will be long-term capital gain under section 112. And this will be short-term capital gain. That's it. This is not a short-term capital gain under 111A. This is normal short-term capital gain. Yes or no? One is taxable at 12.5%, another one is taxable at normal rates. Good? Understood? This was a basic question. Okay? Now see, yesterday we completed 55.2A. But today we are going to discuss the other costs also. If you remember, we were discussing that format. That whenever you will calculate your capital gains, to calculate your capital gains, you have to follow a format. In that format, what you do? Full value of consideration, minus transfer expense, net consideration, cost of acquisition, cost of improvement. So what is full value of consideration? I explained yesterday. What is transfer expense? I explained yesterday. What is cost of acquisition? We were discussing that. So usually what is cost of acquisition? Actual cost. For all the assets, what is the cost of acquisition? Actual cost. Actual cost means purchase price plus purchase related expense. Both you add, you get actual cost. And that actual cost is usually treated as what? Cost of acquisition for all assets. But if the asset was acquired prior to 1st April 2001, you get the option. Option to take fair market value as on 1st April 2001 as what? Cost of acquisition. So if any asset is acquired prior to 1st April 2001, cost of acquisition will be actual cost, or fair market value as on 1st April 2001, whichever is higher. But if the asset acquired prior to 1st April 2001 was immovable property, which property? Immovable property, then fair market value or stamp duty value, whichever is lower, that amount can be taken as cost of acquisition, or actual cost can be taken as cost of acquisition, whichever is higher. Yes or no? Now, for few assets, the cost of acquisition is defined. Like we saw yesterday for intangibles. 55 subsection 2 clause A. 55 subsection 2 clause A defines what? Cost of acquisition for intangibles. What if they are generated? Nil. What if they are acquired? We have to take actual cost. Yes or no? But 55 2A, here we don't get that option to take fair market value as of 1st April 2001. Other than this, for every asset we take fair market value as of 1st April 2001. We can take that cost for every asset. I told you yesterday. Now under 55(2)AA, under section 55(2)AA, the cost is defined for financial assets. Cost is defined for shares, bonus shares, then right, and then right shares. 4 assets. Number 1, shares. Number 2, bonus shares. Number 3, rights and right shares. If you exercise the right, you get right shares. But you don't exercise the right, or you renounce the right in the favor of someone else, then you will calculate the capital gain on renouncement of right. What will be the cost of acquisition of right in that case? Then in that case, you will not get the right shares. The person in whose favor you have renounced the right will get the right shares. So first of all, tell me, can you become a shareholder in a company? How? Okay, no. So if you purchase your equity shares or preference shares, whatever type of shares you are purchasing, you are buying shares. So shares are acquired by you. What will be the cost of acquisition of these shares? This is your capital asset. So whenever the shares will be transferred, these shares will be transferred. Capital gain will be calculated. So what will be the cost of acquisition of these shares? No. How come face value? Face value is 100 rupees. You bought the shares for 200 rupees. So cost will be 100 rupees. By face value, where did you get this logic from? Apply simple logic, no? Whatever may be the face value of the share is 1 rupee. What I have to do with that face value? How much I paid to acquire the shares? In the market, if I am buying the shares, okay, either the listed shares or unlisted shares, whatever shares I am buying, the buying price of the shares will be my cost, no? Low. Or the face value. Buying price. Today you bought the shares of Reliance for 2,500 per share. Face value of those shares is 10 rupees only. So whenever you will sell the shares of Reliance, you will reduce 10 rupees as a cost. Huh? Then how much? Apply some logic. So any type of shares which you acquire, whether listed, unlisted, any type of shares. If you acquire shares, what will be the cost? Actual cost. Simple. So 55(2)AA says that for the shares which are acquired or purchased by the assessee, whenever these shares are transferred, the capital gain will be calculated. To calculate that capital gain, the cost of the shares will be what? Their actual cost. Meaning purchase price plus purchase related expenses. So at the time of buying the shares, whatever cost was incurred to purchase them, plus whatever expenses incurred relating to purchase, both added will give you actual cost. Actual cost is the cost of acquisition, just like it is for every other asset. For this asset also, actual cost will be taken as cost of acquisition. But my question is, if the shares are acquired prior to 1st April 2001, did you purchase the shares in 95-96? Yes. So the shares which you purchased in 95-96 are purchased prior to 1st April 2001. What will be the cost? Can you take that fair market value? Can you take the option to take the fair market value? Yes or no? Because that option is applicable for all assets other than 55(2)(a), other than intangible. So that option will be available for shares also. So if the shares are what? Acquired or purchased. It is acquired or purchased on or after 1st April 2001. What will be the cost of acquisition? Actual cost. And what will be the cost of acquisition if they are acquired or purchased prior to 1st April 2001? Actual cost or fair market value as on 1st April 2001, whichever is higher. So this which you do for all the assets, you are supposed to do it for the shares also. It is defined. For shares also we are defining that same cost you are supposed to take. And you are also going to get what? The option to take the fair market value. If the shares are acquired by you prior to 1st April 2001. Now when you acquire these shares, do you become the shareholder? Based on the shares which you are holding, can the company offer you bonus shares? So based on the shares which you are holding, the company is offering what? Bonus shares. So now you become the owner of bonus shares also. Now bonus shares are also coming to you. What will be the cost of acquisition of bonus shares? Nil. Common sense. Did you have to pay anything to buy the bonus shares? Did you give anything to the company? Company take 500 rupees and give me bonus shares. Company gave you bonus shares just because you are a shareholder. Company did not charge a single rupee to buy give you the bonus shares. So what was the amount at which bonus shares came to you? Nil. What is the actual cost? Nil. That will become the cost of acquisition. That will become the cost of acquisition. Always the cost of acquisition of the bonus shares will be taken as nil. Now what if the bonus shares are allotted to you, given to you prior to 1st April 2001? Can you take the option of fair market value? The answer is yes. That option is available for all assets. So it will be available for bonus shares also. For bonus shares which are acquired prior to 1st April 2001, what will be the cost of acquisition? Actual cost or fair market value as on 1st April 2001, whichever is, and always the fair market value will be higher because the actual cost will be nil. And the fair market value, even if a single rupee is there, no, that fair market value will be higher than the actual cost. So see, if the bonus shares are allotted on or after, cost will be actual cost, which will be always nil. Yes or no? Hello sir. But if the bonus shares are acquired prior to 1st April 2001, you get that option to take the fair market value. In that case, actual cost, which is nil, or fair market value, whichever is higher, here it will be always the fair market value. So what will be the cost of acquisition of bonus shares acquired on or after 1st April 2001? Nil. What will be the cost of acquisition of bonus shares acquired prior to 1st April 2001? Fair market value as on 1st April 2001. That's it. Understanding? Now based on the shares which you are having, now you are holding these shares. Some bonus shares are also allotted. For example, you acquired 100 shares in the company. Based on the holding of 100 shares, company issued bonus shares in the ratio of 1:1. So now how many shares you are having? 200 shares. Yes or no? Now since you are the shareholder holding how many shares? 200 shares. Now the company is going to give you a right. Now the company is going to give you a what right? That the company is offering you a right today. Today is what date? Okay. So now see, I'm making a case in front of you. Okay, no? Mr. Jagan acquired 500 shares in X Limited. There is a company X Limited in which Mr. Jagan acquired 500 shares on 21st January 1999 for rupees 100 per share. Okay, no? 100 per share. Fair market value of such shares as on 1st April 2001 was 125 per share. 120 per share. Per share. Now, on 9th of May 2006, X Limited offered bonus shares in the ratio of 2:1. 2:, meaning how many bonus shares he will get? For every 2 shares held, he will get 1 share as a bonus share. Yes or no? So how many shares he is holding? So how many bonus shares he is going to get? 250 only. Yes or no? Now, on 9th May 2006, X Limited offered bonus shares in the ratio of 2:1. Okay, offered means allotted. I'll write down allotted. X Limited allotted. Now, on 15th of April 2025, he was offered a right in the ratio of 1:1 to acquire right shares. To acquire what? Right shares. At a predetermined price of rupees 200 per share. At a predetermined price of rupees 200 per share. Out of which he exercised the right to acquire 300 shares on 17th April 2025, and the balance right was renounced on the same day in the favor of Mr. Suresh. for 50 for rupees 50 per right entitlement. Okay. Now this is a case which is a beautiful case which I have drafted just now. In front of you only I have written everything. Okay, no? So this type of question can be there in the exam. Still it is not a question. This is an information which the question is giving. Now the required part of the question. Okay. Required part is, first of all, Mr. Jagan sold, Mr. Jagan and Mr. Suresh sold their entire shareholding on 12th of March, 12th of February 2026 for rupees 500 per share, and at the time of sale, transfer brokerage paid at 2% of selling price. Now compute what? Capital gains for both Mr. Jagan and Suresh. Can you do it? But while doing it, what are you supposed to do? You're first supposed to remember what was the cost of acquisition given in 55 to AA for financial assets. So first of all, what are your financial assets? Tell me. Shares acquired. We know the cost of acquisition. We already done. What if bonus shares are allotted? We have already seen that what will be the cost of acquisition. Now since you are having some acquired shares plus some bonus shares, you are already a shareholder. Now based on this shareholding, the company is giving you a right. Company is giving you a right. Right to acquire right shares at a predetermined price. So in my question, if whatever question I have written, okay, in this question, see, you're already a shareholder, you have bought 500 shares, and based on this, you are having some bonus shares. So how many shares you are having? 500 shares, and bonus in the ratio of 2:1, meaning that 250 bonus shares. So now total shares you are having 750. So you are a shareholder holding how many shares? 750. Now on 15th of April 2025, can you see 15th of April 2025? Meaning this year. On 15th of April, the company just gave him a right that if you want, within these many days, you can buy the right shares from the company. And if you want to buy the right shares of the company, you are given the right because you are the shareholder. So since you are a shareholder, the company is giving you a right that before even issuing the shares to outsiders and making outsiders the shareholder of the company, existing shareholders should get the right to acquire the additional shares. But since they are the shareholders from the beginning, they should be issued the shares at certain discounted price. So for example, if the market value of the shares in the market is higher, at that value, we are not going to offer you the right shares. You have a right to acquire these shares at this predetermined price. So the company is offering the shares at how much? 200. If you want, you can buy the shares at 200 rupees per share. If you want, you can buy the right shares at 200 rupees per share. This right was given. This right was given. And when the right was given? So when the right came in your hands, when the company offered the right, hello, now what do you think? You have to exercise this right within how much time? The company will give you some time. How much time the company will give me? 5 years, 50 years, 100 years. It will be certain number of days. Because the company needs what? Money. Hence the company is issuing the shares. So before offering the shares to outsiders, first you take the right. First it is your right to acquire the shares. Okay, no. But that right is not offered for n number of months, n number of years. That will be offered for certain number of days. For example, the company has offered right for 7 days only. Or for 15 days only. Company saying that, see, we are giving you right today. We are giving you right. What right you have? You have a right to acquire what? Right shares in the ratio of 1:1. So if you have 1 share, you can acquire 1 more shares. If you have 2 shares, you can acquire 2 more shares. If you have 5 shares, you can acquire 5 more shares. 1:1. Yes or no? But this right we are giving you, you have to exercise that right. Whenever you exercise that right, the company is going to take how much rupees? How much from you per share? 200 rupees. This right was offered. So if you exercise the right within that window, within that time, then the right will get converted into right shares. Hello? Right will get converted into right shares. But if you don't exercise the right will lapse. The right will. So for example, if the company offered 15 days time, in 15 days time, you exercise the right. Then there is no problem. But in those 15 days, if you are not exercising the right, what will happen? The right will lapse, no? And it will not give you any benefit. And nobody else will also be benefited. So whenever the right is given, no, 2 options are given. Either you can exercise, that is also an option. But if you don't want to exercise, you can renounce the right in the favor of someone else. You can renounce the right in the favor of someone else. Now see, how many shares you are having? Tell me. You are having 500 acquired shares and bonus also you got 250 shares. Okay, no? So total how many shares you are having? So you get right to acquire how many shares? 750 shares. You got a right to acquire right shares in the ratio of 1:1, meaning 750 shares you can acquire as right shares. Out of them, you exercised right for acquiring only 300 shares. What about the balance right of 450 shares? Before the right gets expired, you transferred that right, you renounced that right in the favor of Mr. Suresh, who is not the shareholder of the company. Suresh will be tempted to buy the shares at discounted price. Suresh is an outsider. Suresh is not a shareholder. You are a shareholder, Mr. Jagan. So Jagan, did you exercise the entire right or only the right of 300 shares? So 750 shares right you got the right to acquire 750 shares. Out of them, 300 shares you are acquiring, yes or no? What about the balance 450 shares right? Before it gets lapsed, you renounce this right in the favor of Suresh. Suresh is your uncle's son, no? Suresh is your relative, no? You will not charge anything from Suresh, no? Bloody, if you are giving him a right of 450 shares, now he can buy those 450 shares at a very cheap price of rupees 200 per share from the company. Wouldn't you ask something from Suresh? So you asked Suresh to pay 50 rupees for each right which you are giving him. So how many rights you are giving him? 450 rights. You are announcing 450 rights. For 450 rights, you are charging how much? 50 rupees per right from him. So first of all, tell me, did you get the right? When did you get the right? Out of this right of 750 shares you got on 15th of April. Out of this, you exercised the right of how many shares? On what date? So 750 rights, 300 rights will be converted into right shares. What about the right of 450 shares? Same date. What did I say? Same date. That right of 450 shares was transferred, meaning renounced. So when did a right came to you? And when did you renounce that right? On the date on which you exercised, on that same date you renounced the right also of balance 450 shares. So for how much time you are holding that right? Only 2 days. So that is the holding period of the right, which will be always less than 24 months. Which will be always less than 24. The period of holding of right will never be more than 24 months. It will always be less than 24 months. In some days it will be there. So from where will you start the period of holding? The date on which the company offered the right. The date on which the company offered the right, from that day you are holding the right of 750 shares. So when the company offered 15th of April, you are holding the right till the date of renouncement. So the date on which you renounce that right, till that date only the right is held. So right is a capital asset? Yes. Is it renounced? Yes. Renounced means transferred. Relinquishment is taking place. So capital asset is transferred. Capital gain for renouncement of right will also be calculated. Capital gain for renouncement of right will also be calculated this year. Because you are renouncing the right, meaning capital asset is transferred. Now what will be the period of holding of the right? What will be the period of holding of right? From where to where? Date on which the right is offered. From here you are going to count the period of holding. So in the case of right entitlement, the period of holding will start from date when the right is offered, and it will end on date of renouncement. This is the period of holding of the right. Okay, now this will be certain number of days only. Will never be more than 24 months. So right will always be a short-term capital asset. The right renounced will always be a short-term capital asset. Now, this right you transferred to whom? Renounced to whom? Suresh. For how much? 50 per right. So the amount which you receive on renouncement, is nothing but the money coming to you. Full value of consideration. Right is going, right is renounced. How much is coming? 50 rupees per right share. Yes or no? 50 rupees per right. Not right shares. 50 rupees per right. So you are renouncing right of 450 shares. Per right you are getting how much? 50. That 50 rupees you are getting is the full value of consideration for transferring your right. Based on that you are supposed to calculate the capital gain. So 450 rights you transferred, no? 300 you exercised, 450 you transferred. Per right how much you are getting? 250 into 50. 22,500 will be your full value of consideration. Minus transfer expense. So on transferring the right, did you incur any expense? On transferring the right, Did you incur any expense? No. That brokerage you are incurring at the time of transferring the shares. So at the time of transferring the right, there is no transfer expense. So it is nil. What is the net consideration? 22,500 minus what will be the cost? What will be the cost of acquisition of the rights which you have transferred? Nil. Common sense. You got the right from the company just because you are the shareholder. Just because you are the shareholder, you got the right to acquire 750 shares. Out of them, 300 you acquired, 300 rights you exercised, 450 you renounced. So what is the cost of the right which the company is offering you to purchase the right shares? When you will purchase the right shares, at that time you are going to give how much to the company? 200. Did the company take 200 at the time of giving you the right? So what is the cost of the right? Right came free of cost just because you are the shareholder. So cost of acquisition of right will always be taken as nil. So 22,500 minus nil. What will be the gain? It will always be gain. There will be never a loss on renouncement of right. Understanding? Because whatever price on renouncement you are getting, minus the cost will be always nil. Minus the cost will always be nil. Understanding or not? So what is the cost of acquisition of right? Nil. Understanding? So what is the amount of capital gain? 22,000. Always the gain will come. And that gain will always be short term. So first of all, cost will be always nil. Period of holding starting from the date of right offer till the date of renouncement, which will be certain number of days only, which will never be more than 24 months, which will be always less than 24 months. Yes or no? And the right which is renounced, the cost will always be taken as nil. Always the gain will come, and the nature of that gain will always be short term. In the case of right renouncement. So 55(2)AA says, what? 55(2)AA says that whenever the right is offered, known as right entitlement, yes or no? Whenever the right is offered, if you renounce that right in the favor of someone else. What is this right? This is right based on which the shareholder can acquire additional shares, right shares at a discounted price. So if the right is giving you a benefit that you are a shareholder, you can purchase the additional shares, right shares of the company at a discounted price. So this right is your asset only. Okay, no? So now if the right is what? Exercised, it gets converted into right shares. It gets converted into. And what if the right is not exercised? Can you renounce the right in the favor of someone else? Yes. So whenever you will renounce the right in the favor of someone else, that is known as relinquishment of capital asset, which is nothing but a transfer. And your right which the company is giving is your capital asset. Right is a capital asset, and which is renounced means it is relinquished, means it is transferred. Your capital asset is transferred. Capital gain will be calculated on renouncement in your hands. Now to calculate the capital gain, what will be the full value of consideration? The amount which you have received from the opposite party for renouncement, renouncing the right in the favor of that party, yes or no? So did you renounce the right in the favor of Mr. Suresh? Yes. How much amount you received from Suresh? 50 rupees per right. That will be your amount received on renouncement, will be treated as your full value of consideration for renouncing your right. Now, what will be the cost of acquisition of the right which you have renounced? This will be always nil as per 55(2)AA. You have to take the cost of acquisition as nil. Yes or no? Will it result into gain or loss? It will always result into gain. If ever you are getting a loss over here, now bring your SRO number to me, okay? You will never ever get a loss here. You will always get a gain. Why? Because the cost you are supposed to take as nil. Understanding? Now what will be the, it will be always short-term gain. Okay. What will be the period of holding of the right offer? How can you say that the gain is short-term gain? You are going to say this based on the period of holding of the asset transferred. What asset you have transferred? Right. So what is the period of holding of that right? From the date on which the company offered the right, date of right offer till the date of renouncement. This is the period of holding of the right offer. Will always be certain number of days, which will always be less than 24 months, as the case may be. Okay. So now what will happen? You will calculate the capital gain on the right renouncement. Now tell me one thing. The right out of the right, how many shares right you got? 750 shares, no? In my question, how many shares you got? Out of 750 shares right, you exercise the right of. So that 300 shares will be your right shares. So now you will go to the company, you will tell the company, that company, see, you have given me a right of 750 shares. Out of that, I want to exercise right of 300 shares. So company said, no problem, we are going to issue 300 right shares to you. So will you buy right shares? Will you buy right shares? How many right shares? So what will be the cost of acquisition of the right shares? 200 rupees, which you are going to give to the company. So the company is offering you right shares. See, the company was offering a right in the ratio of 1:1 to acquire the right shares at predetermined price of. So whenever you will exercise the right, how much amount you are going to give to the company? 200 rupees per share. So 300 shares coming to you, 300 right shares will be issued to you. How much amount you are going to give to the company? 200. That is your actual cost. That is your actual cost. Will be treated as cost of acquisition. So 200 into 300 shares, 200 rupees per share into how many shares? 300 shares. This is the actual cost. And that actual cost will become your cost of acquisition. Now what if these shares, right shares, are issued prior to 1st April 2001? Will you get that option? Yes. Option to take the fair market value is also available. Option to take the fair market value is also available because it is available for all assets. So for right shares also it will be available. So what if the right shares are acquired prior to 1st April 2001? Actual cost or fair market value as of 1st April 2001, whichever is higher. And what if the right shares are acquired on or after 1st April 2001? Actual cost. Understanding? But tell me, what will be the actual cost in your hands? The amount which you pay to the company at the time of exercising the right to buy the right shares. So the amount actually paid by the shareholder, So if the right shares are acquired by the shareholder himself by exercising the right, so what will be the cost of acquisition? It will be actual cost. Sir, what is actual cost? Amount paid by the shareholder to the company to acquire the. So when you will exercise the right to buy the right shares, how much amount you are going to give to the company? 200. That 200 which you are giving to the company will become your actual cost, and that is nothing but your cost of acquisition. And either that actual cost or fair market value, whichever is higher, can also be taken as cost if the right shares were acquired prior to 1st April 2001. Now tell me, do you remember those 450 rights you renounced in the favor of Suresh? What Suresh will do with those 450 rights? Now Suresh will go to the company and Suresh will exercise that 450 shares right. Suresh is not buying that right from you to make Honda. Hello? What Suresh will make from those rights? Honda? Suresh is taking that right from you for what? Because Suresh wants to buy those 450 shares. Yes or no? So the moment you will renounce your right in the favor of Suresh, now Suresh is entitled or eligible to buy those 450 right shares. Now can I say Suresh will buy the 450 right shares? Yes or no? What will be the cost of acquisition? Actual cost. What will be the cost of acquisition? Actual cost. At how much Suresh is going to buy now? The right was to acquire the right shares at 200 per share, and now this right is with the Suresh. Suresh is going to exercise this right. How much amount Suresh is going to pay to the company now? 200. So what will be the cost of acquisition of shares, right shares in the hands of Suresh? 200, no, 250. Because Suresh will give 200 to the company to buy the shares, right shares, but to do that, Suresh had to acquire the right from you. And for that right, Suresh had to pay how much? 50 rupees per right, yes or no? So the amount paid to acquire the right will also be added in the cost of your right shares. Understanding? So what will be the cost of each share? Amount paid to the company 200 plus amount paid to acquire the right. So amount paid to the company plus amount paid to the shareholder on renouncement. This will be the actual cost of one right share in the hands of Suresh, meaning the non-shareholder. Yes or no? If the right is renounced in his favor and now he exercises the right and buy the right shares, what will be the cost of acquisition? Actual cost. And what is actual cost? The amount paid to the company for each right here plus the amount paid to the shareholder on renouncement of right. So this will be the actual cost. But if the right shares are acquired prior to 1st April 2001, then fair market value as on 1st April 1 can also be taken as cost. So this actual cost or fair market value as on 1st April 2001, whichever is higher, can also be taken as cost of acquisition. Will you remember this? Will you remember this? Sure. Now see, in this entire question, no, this concept is exploited. But first of all, tell me, did you understand what should be the cost of acquisition of acquired shares? The shares which you acquire. Come on, tell me. You are an assessee. You are acquiring shares, purchasing shares. So what will be the cost of acquisition of these shares for you? Actual cost. Actual cost. Purchase price plus purchase related expense. Actual cost, yes or no? If the shares are acquired prior to 1st April 2001. Actual cost or fair market value as on 1st April 2001, whichever is higher. Done. Now based on the actual shares, based on the original shares which you have purchased, can you get bonus shares? What will be the cost of acquisition of the bonus shares? Actual cost, which is nothing but nil. Yes or no? But what if the bonus shares are acquired prior to 1st April 2001? Actual cost or fair market value, whichever is higher. Always the fair market value. Done. Now based on the shareholding, can the company offer you right? Can you renounce that right in the favor of someone if you don't want to exercise the right and buy the right shares? So you can renounce the right in the favor of someone else. What will be the on renouncement of the right? Capital gain will also be calculated at that time. So if you are a shareholder, the company has offered you right. If you are a shareholder, the company has offered you right. So if you don't want to exercise the right and buy the right shares, you always have the option to renounce the right in the favor of someone else. So what if that right to acquire the right shares, that right was renounced? At that time also the capital gain will be calculated. To calculate capital gain, what will be the cost of acquisition of the right? Right renouncement, what will be the cost of acquisition of that right? Nil. Common sense. Nonsense. What will be the cost? Nil. Because you are calculating the capital gain on renouncement of, right? To calculate that capital gain, what cost you are going to take? Nil. Simple. What will be the period of holding of the right? What will be the period of holding of the right? From the date on which the company offered the right till the date of renouncement. This is the period of holding. This will be always certain number of days. Will always be less than 24 months. So, right is always a short-term capital asset. Right which you are renouncing will always be a short-term capital asset, and resulting gain will always be a short-term capital gain. And it will always be a gain. Why? Because the cost of acquisition of the right you are going to take as nil. As per 55(2)AA. The cost of acquisition you are going to take as nil. As per 55(2)AA. Will you remember? Now, if you renounce the right, the story ends here. If you renounce the right, now you are not going to get what? Right shares. Now that right shares will be given to the person in whose favor you have renounced the right. He was a non-shareholder. So you are a shareholder, you are renouncing the right in the favor of someone else who is a non-shareholder. Now he will acquire the right shares, no? Who will acquire the right shares? The non-shareholder in whose favor you have renounced your right. So your capital gain is calculated now. On announcement of right, your capital gain is calculated. Your story is over. Now who is having that right? Now who is having that right? The person on whose favor you have renounced the right. The person in whose favor you have renounced the right. He is having that right. In my example which I wrote, you are an assessee, you are Mr. Jagan. Did you renounce your right? So on renouncement your capital gain will be calculated, your story ends. Now it was renounced in the favor of Suresh. Who is having the right now? Suresh. Will Suresh exercise that right? Will Suresh get the right shares? What will be the cost of acquisition? 200 rupees, meaning the amount given to the company to buy the right shares plus the amount given on renouncement to Jagan will be my cost of acquisition of right shares in the hands of Suresh. So whenever Suresh will calculate the capital gain of right shares, whenever Suresh will calculate the capital gain of his right shares, what cost of acquisition Suresh will take? 250, which is nothing but actual cost. But fair market value as on 1st April 2001 can also be taken as cost. If Suresh had acquired the right shares prior to 1st April 2001. But in my example it was on or after 1st April 2001, no. So we'll take actual cost. Fair market value option is not available for shares held by Suresh because Suresh acquired the right shares on or after 1st April 2001. Now tell me, what if you don't renounce the right? The company gave you the right, no? You don't renounce. What if you exercise that right? So now you will get the right shares. Are you shareholder? Yes. Company offered you right. Instead of renouncing that right, you exercise that right. So what will you have now? Right shares. What will be the cost of those right shares? The amount actually paid to the company. Amount actually paid to the will become your cost. Will become your actual cost. It's nothing but your cost of acquisition. Understanding? So we are talking about Jagan. What if Jagan has exercised the right? Will Jagan get the right shares? Yes. What will be the cost of acquisition of right shares of Jagan? It will be 200 rupees. The amount paid to the company. Understanding? Sure, sir. Should I move ahead? Now, based on this information, based on whatever we have studied, I have discussed, you are supposed to solve that question, which I have just now written. If you correct that question now, understand, your basics are thorough. Because this is one of the most difficult questions which I have framed on your basics part. Understanding? But wait. After this, one or two more questions I will dictate. Okay? Just to see that how actually you have understood the things. But before this, sir, what if these shares are sold in the future, these shares are sold in the future, and these right shares are also sold in future? Cost of acquisition you have told us, sir. Whenever these shares will be sold in the future, capital gain will be calculated. To calculate that capital gain, I have to take this cost only. Yes or no? Cost of acquisition you have told, sir. No problem, we take the cost of acquisition like this. But after reducing this cost, the capital gain will come. Capital gain will be short term or long term. Depends on the period of holding. Type of asset, meaning depends on period of holding. Capital gain will be long term if the asset is long term. Shares are long term. Capital gain will be short term if the shares are short term. Sir, how will I come to know that the purchased share, bonus shares, right shares, they are short term or long term? How will I come to know? I will have to check their period of holding. Period of from which date to which date? Apply some logic. First of all, let's talk about these shares. Shares which are purchased by you. Come on, tell me. From which date you start holding these shares? Date of purchase till their date of sale. This is their period of holding. But only if these shares are listed. Only if these shares are. So if listed shares are there, you are going to take from date of purchase to date of sale. And period of holding, how much you check? Date of purchase to date of sale. This is the period of holding. Yes or no? Period of holding you check 12 months or 24 months. These shares are listed shares, no? So period of holding should be this. And this period of holding should be 12 or 24. 12 months or less. Shares are short term. More than 12 months, shares are long term. No problem. Understanding? Wait. Now what if these shares are unlisted? You will check 24 months for unlisted shares. This is not a listed security. Now it is unlisted shares. For unlisted shares, how much period of holding you are going to check? 24. From where to where? So date of purchase? No. For unlisted shares, you are always going to check from date of allotment. So the date on which the shares are allotted. The date on which the shares are allotted. From that date, the period of holding will start. Understanding? So which shares? Which shares? Unlisted shares. The period of holding will start from date of allotment. It will end on date of transfer. Date immediately preceding date of transfer. And if this period of holding is 24 months or less, the share size short term. More than 24 months, shares are long term. For unlisted shares, always from the date of allotment. But what if the shares are listed? Then these shares are not allotted on your name. These shares are allotted on the name of NSDL CDSL, depository, which then converts these shares into dematerialized form and which are traded in the market. So that dematerialized shares comes into your demat. You are just the beneficial owner of those shares. These shares are not allotted on your name. So in the case of listed shares, in the case of the company will allot the shares on the name of depository, CDSL or NSDL. CDSL or NSDL will convert these shares into electronic form, dematerialized form. And now these shares which are converted into dematerialized form, electronic form, will be traded in the market which you are buying. And when you buy these shares, meaning the company is not allotting you shares, you are buying the shares from the market in the dematerialized form. Now these shares will come in your demat account. You are just the beneficial owner of those shares which are allotted by the company to the depository. So depository is not the beneficiary. Depository is just the legal owner to whom the shares are allotted for the purpose of conversion into demat form. But all the benefits of these shares, gain, then dividend, will be given to you because you are the beneficial owner of the shares. Understanding? So, in the case of listed shares, no, the shares are never allotted on your name. You buy the shares from the market, and the date on which you buy them, from that date you start holding them. So date of purchase to date of sale. This is your period of holding. 12 months or less, it is short term. More than 12 months, it is long term. Understanding or not? But in the case of unlisted shares, these shares are allotted to you guys. These shares are not traded on the stock exchange. These are not listed. These are unlisted. You directly go to the company and company will allot you these shares. So from which date you start holding the shares? The date on which the company allots. From that day you start holding the shares. Till what date? Date immediately preceding to date of transfer. If this period is 24 months or less, the shares are short term. And what if these shares are more than 24 months? The shares are long term. Understanding? What if bonus shares are there? Bonus shares. Bonus shares also, the period of holding you will start from date of allotment. Date on which the bonus shares are allotted. From that date, the period of holding will start. Till the date immediately preceding to date of transfer. If this period is 24 months or less, then short term. More than 24 months, long term. Understanding or not? This is when the bonus shares are unlisted. What if the bonus shares are listed? If you are having listed shares, so based on the listed shares, you are also going to get listed bonus shares, no? So listed bonus shares will be allotted to you? No. Those listed bonus shares will be, bonus shares will be allotted on the name of CDSL NSDL, and CDSL NSDL will convert them into demat form, and that will directly be credited to your demat account. So the date on which your demat account is credited, the date on which the bonus shares comes in your demat account is the date from which you start holding the bonus shares. Understanding? So when will you start holding the bonus shares? The date on which the bonus shares will come in your demat account in case of listed bonus shares. Yes or no? And till what date you are holding? You are holding till date of sale. So date when it was credited to your demat account till the date of sale, this is a period of holding. 12 months or less, short term. More than 12 months, long term. If the bonus shares are listed. What if the bonus shares are unlisted? Period of holding you will start checking from date of allotment till the date immediately preceding to date of transfer. If this period is 24 months or less, then short term. More than 24 months, then it is long term. Yes or no? Same logic you are supposed to apply for right shares. Tell me right shares. Right shares will be allotted. Unlisted right shares will be allotted to you. So you start holding them from the date of allotment till the date immediately preceding to date of transfer. Whether you are a shareholder or you are a non-shareholder. Anyone acquiring the right shares will be held from which date? From the date of allotment till the date immediately preceding date of transfer. If this period is 24 months or less, short term. More than 24 months, long term. Understanding? In case of unlisted right shares. What about the listed right shares? Common sense. The date on which you purchase them. The date on which you purchase them. Date of purchase. From that date to the date of sale. And this period is 12 months or less. Then the right shares, short term. What if it is more than 12 months? Long term. Done, sir. Understanding? So, and for right offer, what will be the period of holding? Right offer? Right which you are renouncing, you are calculating short-term gain on renouncement. What will be the period of holding? The date on which the company will offer you the right. Till the date of renouncement. That is the period of holding. Will always be certain number of days only. Less than 24 months. Always short term. Understanding? So pay attention. Now see, in case of shares, in case of whether shares are acquired, whether shares are bonus shares, whether the shares are right shares. Check how many months? 24 months. If the shares are unlisted, check how many months? 12 months. If the shares are listed, 24 or less, short term. More than 24, long term. 24 or, 12 or less, short term. More than 12 months, sir, if the shares are listed, if the shares are, period of holding will start from date of purchase till the date of sale. That's it. In case of bonus shares, date when the bonus shares are credited in your demat account till the date of sale. Yes or no? Then sir, what if the shares are unlisted? Period of holding will always start from date of allotment. Whether the shares you acquire, whether the shares are given as bonus, whether the shares are given as right shares. Always start from date of allotment. Understanding? Till the date immediately preceding to date of transfer. Done, sir? Done, sir? So this is the end of 55 2A. See, unlisted shares from the date of allotment till the date immediately preceding to date of transfer. For listed shares other than bonus shares from the date of purchase till the date of sale. For listed bonus shares from the date debited to demat account till the date of sale. Understood? Everything which I am speaking is written in front of you. Now you have to, comprehend this entire information. You have to consolidate this entire information and use this knowledge while solving the question. Okay? Will you solve the question? Let's go. Come on. Start solving this question. Don't talk, huh? Without talking, start solving this question. See the same question I am solving now. Pay attention. So, first of all, we are doing computation of capital gains for Mr. Jagan. We are computing the capital gains for Mr. Jagan. Now tell me, capital gains of Mr. Jagan which we are going to calculate, for which previous year? 25-26, assessment year 26-27. So, previous year 25-26, assessment year 26-27. So, in the assessment year 26-27, we are calculating the capital gain for 25-26. Now, in this year, Jagan is selling what? All his shares. See in the last line, in the question I have given, both Mr. Jagan and Mr. Suresh sold their entire shareholding. So whatever shares since the beginning Jagan is having, all these shares he is selling. And Suresh is also doing the same thing, yes or no? So tell me, which type of shares Jagan is having? Acquired shares. How many shares were acquired? 500. So can I say 500 shares which were acquired by him, acquired originally 500 shares which were acquired originally. Then based on these 500 shares he got what? Bonus shares also. How many bonus shares? So 250 bonus shares also he is selling. Bonus. Yes or no? Then based on this 750 shares he is getting a right to acquire right shares which he is renouncing. So right renouncement is also happening in this year. So you are going to calculate capital gain of right renouncement also. Hello sir. So not just the shares but the rights are also renounced in this year. So for right renouncement also the capital gain will be calculated. Yes or no? So what are you going to do? Right entitlement. Right of how many shares? 300 shares which is renounced. Yes or no? For that right also you are going to calculate the capital gain. Then 450 right shares he is purchasing or Suresh is purchasing. So this will be for 450 shares. My mistake here. This will be for 450 shares. 450 shares, right, which is renouncing in the favor of Mr. Suresh. For that he is going to calculate the capital gain. But for 300 shares, which he acquired as right shares. This is right shares. Okay, no? This right shares. Now these assets is transferring during the previous year. Understanding or not? Now first of all tell me, what is the date of acquisition? What is the date of acquisition of 500 acquired shares? Tell me. 21st January 1999. So can I write down 21st January 1999? Yes. Now 250 bonus shares. 9th May 2006. 9th May 2006. I am assuming that the dates which are given, see, it is given that Mr. Jagan acquired means purchased on this date. If nothing is mentioned, the shares are unlisted. If nothing is mentioned, the shares are unlisted. And the date on which it is purchased, on that same date, it was allotted also. If the date of allotment is different, they would have definitely given me. So if nothing is mentioned, meaning that on the date of purchase only they were allotted. And nowhere it is given in the question that the shares are listed. So till the time your examiner is not telling you, the question is not telling you, you are not going to take the shares as listed shares. Any hint will be given in the question. Then also, from that hint also you will come to know that the shares is listed. Or the examiner will specifically tell you that the shares are listed. Only then take the shares as listed shares. Otherwise, the shares are unlisted. Unlisted shares, the date of acquisition starts from date of allotment. Period of holding will start from date of allotment. And if nothing is mentioned, the shares are allotted on the date on which I am purchasing them. Yes or no? So when the shares are allotted, these shares are allotted on 21st January. These are allotted on 9th May. Okay. Now tell me, if I say that right of 450 shares which I am renouncing, when did I acquire that right? When did I acquire that right? The date on which the company offered the right is the date on which I am acquiring the right now. So it will start from 15th of April 2025. Now 300 right shares. Check 300 right shares. When I am acquiring the 300 right shares, 17th of April I am exercising the right of 300 right shares. If nothing is mentioned, the right shares are allotted on the same day. Understanding? So, tell me, 17th of April 2025. Now, for all the assets, I get the date of allotment. Now, all the shares are transferred on same date, on 12th of February 2026. So, 12th of February 2026, Jagan has sold all his shares. Jagan has sold all his shares. But the right was renounced on what date? Right of 450 shares were renounced on 17th April only. The date on which he is exercising the right to acquire the right shares. On that same date, the right was renounced also for 450 shares. So right of renouncement. Renouncement is the date of transfer. 17th April 2025. Now tell me, based on this period of holding, what you can say? This is less than or more than? Greater than 24 months. Greater than 24 months. This is less than or equal to 24 months. This is greater than 24 months. Done, sir? Everyone got this? Now, this is long-term capital asset. This is also long-term capital asset. This is short-term capital asset. And this is long-term capital asset. Understanding? Now here I have to calculate the capital gains. Okay? Pay attention. So tell me, full value of consideration is nothing but the selling price. So how much is the full value of consideration? At what price the shares are sold? 500 per share. So 500 into 500. 500 into 500. 500 per share. 500 shares are sold. Tell me, 2,50,000. Now 250 bonus shares are also sold for 500 per shares, no? Are you all getting this or not? So tell me how much here? 1,25,000. Sir, right was renounced for how much? How much? 50 rupees per right. Yes or no? And how many rights are renounced? 450. Bonus shares are 300 bonus shares. Those bonus shares also I sold for 500. Meaning, Jagan sold all his shares for rupees 500 per shares. But Jagan renounced the right for 50 rupees per right. Yes or no? So tell me, here it will be 22,500 and here it will be 1,50,000. Everyone got this? Less. Less what? Transfer expense. In transfer expense, do you have brokerage? At the time of selling, the brokerage paid was 2% of selling price. Yes or no? So 2% brokerage. And this 2% of what? Selling price only, no? So 250 into 2% will be how much? How much? 5,000. 1,25,000 into 2%. 2,500. Don't write any brokerage over here. Because at the time of renouncement, you are not paying any brokerage. You are paying brokerage at the time of sale of shares. So 1,50,000 into 5%, 2%. 3,000. Transfer expense you got. You reduce that transfer expense. You are going to get net consideration. 250 minus 5,000. 2,45,000. This will be 1,22,500. This will be 22,500. This will be 1,47,000. Net consideration you got. Now from this net consideration you are going to reduce cost of acquisition. And no need to write any cost of improvement. Because you never improve the shares. Okay. So what is the cost of acquisition? Come on, tell me. Acquired shares. Shares are acquired for 100 rupees per share. So actual cost is 100. And since the shares are acquired prior to 1st April 2001, you get the option to take the fair market value also. Fair market value on 1st April 2001 is, so 100 or 120, whichever is higher. Will you take 100 or you will take 120? Simple. So 120 into how many shares? 500 shares. So 120 into 500 shares. 500 shares multiplied by 120. How much? 60,000. Understanding? Even if the shares are long term, indexation is not available. Why? Because the transfer of the share is taking place in this year on or after 23rd July 2024. So any asset transferred on or after 23rd July 2024, even if the asset is long term, indexation benefit is no more available. Without indexation, you are supposed to calculate the long term gains now. Understanding? So tell me, how much is the long term gain here now? Long term gain 1,85,000. Now for the bonus shares, sir, bonus shares, check now. Bonus shares were allotted on what date? 9th of April 2006, meaning on or after 1st April 2001. So the bonus shares are acquired on or after 1st April 2001. What will be the cost of acquisition? Actual cost, which is nothing but nil. So here the cost of acquisition will be nil. So how much will be the capital gain? 1,22,500. Entire amount will be the capital gain. And for the right renouncement also, the cost of the right will always be taken as nil. And this will be 22,500. Yes or no? And now you have to determine the cost of 300 right shares. So when did you acquire the right shares? 17th April 2025. 17th April 2025. Just a moment. Just a moment. This is less than my mistake. For right shares, this will be less than. Here, sir, it will be less than, and this is short-term capital asset. My mistake was there, guys. Okay. So for right shares, which you acquired on 17th April, which you are selling on 12th of February, the period of holding was less than 24 months. The right shares are also short-term capital asset for you. Yes or no? So for these right shares, what was the cost? 300 right shares which you have acquired from the company. How much amount you have paid to the company? 200 per share. Yes or no? That's nothing but your actual cost. That will become the cost of acquisition. So 200 into 300 shares. 300 shares multiplied by 200 per share. It will be 60,000. Reduce that. 87,000. Now see, this is your long-term gain, this is your long-term gain. Long-term capital gain under which section? Under section 112. Under section, and this is also long-term capital gain under section 112. Can I say this is your short-term capital gain and this is also your short-term capital gain? You have to calculate them separately. Please remember. And what you are doing? You are calculating capital gain of all the shares together. Yes or no? Some shares are short-term, some shares are long-term. What if any share is having a loss? For example, if the loss was here, then you are setting off short-term loss against long-term gain. No problem. Okay. But what if there was a loss here? No, not here. What if the loss was here? Can you set off the loss from short-term gain? But if you are calculating together, what are you doing? The net amount of gain you will calculate, meaning you have set off the long-term loss against short-term gain, which is not allowed. Understanding? And also, if you will calculate the capital gain separately for each type of shares, what will happen? You will know that which type of gain is long-term gain, which type of gain is short-term gain. You will be able to identify the correct tax rate also. So, whenever the shares of the same company are purchased in lots, for every lot, calculate the capital gain separately, assuming the lot is a separate capital asset itself, because each lot is purchased at different time, at different rate, and maybe the shares in that lot are short-term, shares in another lot are long-term. You never know. Understanding? Is it easy? Easy or difficult? Tell me. Whatever things I have taught you, from that only the question is framed. And from that only the answer is derived. You have to do the presentation exactly in the same way. Done. Now we are going to compute the capital gain for Mr. Suresh. For Mr. Suresh. Ayyo. Okay. Now for the same previous year, we are going to calculate capital gain for Mr. Suresh. Shall we? For Suresh is acquiring any asset? Yes. Suresh is acquiring only right shares. And those right shares are acquired in this year only, and they are sold also in this year. Understanding? So what will be the capital asset? Come on, tell me. Capital asset in the hands of Suresh will be 450 shares, which are right shares, which Suresh has acquired. Yes or no? What will be the date of acquisition of the shares? When Suresh has acquired, tell me. Hello? If the right was given on the name of Suresh on 17th April, if nothing is mentioned, Suresh will exercise the right on the same date, and the company has also allotted on the same date. If nothing is mentioned, you tell me no, that when he is exercising the right, when the right shares were allotted, if the question is silent about that, I will assume that on the date on which I got the right, on that same day I exercised, and on the same day the company allotted also. Yes or no? So the right shares were acquired by Suresh on what date? 17th of April 2025, and these were transferred by him on same date, no, 12th of February 2026. 12th of February 2026. Now looking at this, can you see that the period of holding is less than or equal to 24 months? Tell me. So right shares held by him is a short-term capital asset, and we are going to calculate the short-term capital gain. Understanding? Now to calculate that short-term capital gain, sir, same format, full value of consideration. Sir, full value of, that will be nothing but selling price. So at what price he is selling, sir? He is also selling for 500 rupees per share, no? So how many shares he is having? 450 shares. He is also selling for 500 rupees per share. So 450 into 500 will be how much? 2,25,000 minus transfer expenses. Is he also paying brokerage? Yes. 2% brokerage. So 2% of this will be how much? 4,000. Can you reduce? You will get 2,20,500. This is what? Net consideration minus cost of acquisition. Now be careful. What will be the cost of acquisition in his hands? 450 shares are acquired by him. For how much cost? 200 which he has given to the company, and 50 for right entitlement. Yes or no? So first of all, he got the right from the company from Jagan for 50. Then after having this right, he got the right and he exercised the right and paid how much to the company? 200. So 250 per share will be his cost. And that actual cost will become his cost of acquisition. Yes or no? So 450 to 250 will be 1 lakh. Reduce that amount. 1 lakh. This final amount is what? Short-term capital gain. Taxable at what rate? 20%, no? This is 111, no? Normal rate. Done, sir? If this type of question is there in the exam, 100% this will be for minimum 6 to 8 marks. Just imagine what is there in this question. Nothing. You just have to find out the correct things, put them at correct places, and you get full marks in the exam. Understood, sir? So, now, one more thing I will tell you. See, one example I am taking. Okay. If there is one assessee, there is a company, ABC Limited. Which company? Okay. So, shares of ABC Limited are acquired. Shares of ABC Limited, this company, are acquired by the assessee. How many shares are acquired? First he is acquiring 100 shares. These 100 shares are acquired on 9th of May 2005 at rupees 400 per share. Now that assessee acquires the same company's shares once again. Possible or not possible? So once he acquired 100 shares on 9th May 2005 for rupees 400. Of this same company, again he is acquiring some shares. Now he is acquiring 200 shares. How many shares? On 11th of July 2009 at rupees 510 per share. Now this company is giving 300 shares as bonus on 15th of December 2024, and this bonus was issued at what? Nil. Done, sir. Now he is acquiring 400 shares. How many shares? On 7/7/2025 at rupees 700 per share. Done, sir. Now how many shares he is having? Tell me. 1,000 shares, no? 1,000 shares he is having. These 1,000 shares of the same company. But these 1,000 shares are bought at once, no? In different lots. Understanding? Now tell me, in these 1,000 shares, from these 1,000 shares, for example, two possibilities are there. All 1,000 shares are sold. Possible? Sold on 19th of August 2025 for 690 per share. How much? 690 per share. Possible, not possible? First possibility. Now second possibility. Out of the 1,000 shares, he is selling 700 shares only. 700 shares sold on same date, on 19th of August 2025 for same 690 per share. For 690 per share. Now first we have to assume this possibility and calculate the capital gains. This will be my first part. Now the same question can tell you that instead of all the 1,000 shares being sold, only 700 shares out of these are sold, and now calculate the capital gains. How will you calculate the capital gains? Calculate. Please do the needful. These ABC Limited shares, see, whenever purchased at the time of purchase, brokerage was given at the rate of 1%. Okay, no? At the time of purchase, the brokerage was given. Okay? At the time of purchase. At the time of giving the bonus shares, there will be no brokerage. Getting my point? And at the time of sale also, brokerage is given at the rate of 2%. Brokerage is given at the rate of 2%. Okay. And assume that all the shares of ABC Limited are unlisted. And the assessee is Mr. Rohan. Mr. Rohan. Come on, start solving. First you will solve this part. Once this part is over, then you are going and solving this part. Come on. computation of capital gains. Okay now? Mr. Rohan. Individual. Nothing mentioned then ROR. Pen dash. Previous year 25, 26. Assessment year 26, 27. Computation of capital gains. Now tell me, how many shares he is having? 1000, no? All the 1000 shares are sold, meaning all the lots are sold. 100, 200, 300 and 400. So, 400 shares which were acquired by him. They are also sold. 300 shares which are bonus shares. They are also sold by him. 200 shares. These shares are also acquired shares. These shares are also sold. And 100 shares which are acquired shares. These shares are also sold. Okay. So 100 shares. Date of acquisition and date of transfer. What about 100 shares? Date of acquisition, tell me first. 9/5/2005. 11/7/2009. 15/12/2024. And 400 shares. 7/7/25. All these shares sold on the same date, no? 19th of August 2025. Done? So if you can see, these shares are long term because their holding period is more than 24 months. Long term capital asset. And these shares are short term because their holding period is less than 24 months. Yes or no? These shares are also short term. Done, no sir? Now I am going to calculate the long term gain for first two and then short term for last two. So what is the full value of consideration? Nothing but selling price. So selling price is how much? 690, no? So 100 shares into 690 will be 69,000. 69,000. 200 shares into again 690 will be 1,38,000. Then 300 shares into 690. How much? 2,07,000. And 400 shares into 690 will be 2,76,000. Less what? Transfer expenses. Any transfer expenses there? 2% brokerage. So how much is 2%? 1380. Second one, 2,000 760. Next one, 4,140. Last one, 5,520. Everyone getting this? Net consideration. First one, 60, 67, 620. Next one, 135, 240. Next one, 2 lakh, 860. Next one, 2 lakh 7,480. Everyone getting this or not? So from this net consideration I will reduce 2,70,480. 2,70,480. Is it okay? Okay. Now cost of acquisition. First of all, tell me 100 shares are purchased for 400. So 100 into 400 plus 1% brokerage. So total 40,400. Got it or not? How did you get it? 100 into 400 rupees per share plus 1% brokerage. Yes or no? Now 200 shares you acquired for how much? 510. 200 into 510 plus 1% brokerage. 1 lakh 3,020, no? 3,020, right? Next, these 300 shares, the cost will be nil because they are bonus shares. Okay, no? 400 shares you acquired for 700 rupees. Yes or no? And plus 1% brokerage. Total 2 lakh 82,800. Everyone got this? So calculate the capital gain. First case, 27,220. Next one, 30,000, 32,220. Next one, 2,02,860. Next one, 12,000. So this is your long-term capital gain. Okay, no? LTCG under section 112. This is also LTCG under section 112. This is your STCG and this is your STCL. Remember, I have told you that short-term capital loss can be set off against short-term gain also and long-term gain also. But long-term capital loss can be set off against long-term gain only. Yes or no? Do you have short-term loss? Can you set off against short-term as well as long-term? So always first set off against short-term. So how much taxable short-term gain remaining? 1,90,000. This final amount is taxable short-term capital gain remaining after set off. Yes or no? And what is your total long-term gain? $59,440. Yes or no? This is known as your taxable LTCG under section 112. Done, sir? Difficult, no? Very difficult. Now see, same question. If all the assets are not sold, only 700 shares are sold. So 700 shares are sold, no? Which 700 sold? With 700. Always follow FIFO. First in, first out. So can I say these 100 shares are sold? 200 shares are also sold. These 300 shares are also sold. And 100 more remaining is sold out of this 400. And whatever shares are remaining, how many shares are remaining? Are remaining from this 400 only. Later on, whenever those 300 shares will be sold, no, their cost of acquisition will be 700. Their period of holding will start from 7th of July. Understanding? So now, first case is if all 1000 shares were sold. This was our first case. Now second case, what I am going to do? Wait, see here. Copy paste only. Everything copy paste. But what things will change, I tell you. Just pay attention over here. What I have done? Copy paste the same solution. Okay, no? Now if out of 1000, if only 700 shares are sold. So meaning these 100 shares are sold. Yes or no? These 200 shares are also sold. 300 are also sold. Out of these 400, no? Out of these 400, now how many shares will be sold? 100 shares only. So 100, 200, 300 and out of 400, 100 shares are sold. Getting my point? Everyone, are you understanding what I am doing? Out of 400, only 100 shares are sold. So that is going to affect my calculation? Yes. Not in the first three cases, but only last case. So in the last case, instead of 400 shares, now I will calculate for how many shares? 100 shares. Yes or no? So tell me now here, how much I will take? 100 into 690 will be 69,000. 2% of that. 1380. Reduce 620. Yes or no? Now, these 100 shares had a cost of 700 plus 1%. 70,700. And this will be giving me a loss. Loss how much? 3080. Now this loss you set off against 2,02,860. 1,99,780. Everyone got this? Last time loss was 1,90,540. Sorry, a final amount, and now it is 199,780. Everything remaining same. Now if I am extending that question, color, pink color. Now extending that question. If the remaining shares, remaining 300 shares are also sold on 26th March 2026, meaning this year only, on 26th March, the remaining 300 shares were also sold for 750 per share and brokerage paid. Brokerage at the rate of 2% is paid. Then compute what? Compute capital gains. Will you be able to do? Yes. Now which 300 shares are sold? Come on, tell me. Out of these 400, right now I have sold 100. So the remaining 300 is out of this 400 only, no? So what I will do? First of all, I will say computation of capital gains for 300 shares. Yes or no? So same year I am going to calculate for Mr. Rohan. What I'll do the same thing. Okay, computation of capital gain. Copy and paste. Pay attention, huh? Mr. Rohan. Previous year 25, 26. Assessment year 26, 27. How many shares are sold? 300 shares. Okay. In balance were sold. So for that same year, now for these 300 shares, the capital gain will be calculated separately. So now instead of 3 columns, I will make 4 columns. How many columns? In that same solution, I would have increased one more column. Out of 400 shares, 100 shares sold separately with the 700 shares, yes or no? And the 300 shares sold later on. So for those 300 shares, the date of acquisition would have been this month, this only. But the date of transfer would not have been 19th of August, it would have been 26th of March. Still the period of holding is less than 24 months and the asset is short term. Getting my point? So that extra column which I have to add besides that, okay, no, that extra column I am making. Understanding? So tell me, what is the date of acquisition? Sir, it was 7th of July 2025. They are sold on 26th of March 2026. This gives me the period of holding of less than 24 months. Therefore, they are also short-term capital asset. Now, how to calculate the capital gain? Same, sir. Full value of consideration minus transfer expense, net consideration, and I will get what? What is the selling price? Tell me now. Now the shares are sold for 750. So 300 into 750 will give me 2,25,000. Getting me or not? Next one, 2% brokerage. How much? 4,500. Reduce that. 2,20,500. Okay. What will be the cost of acquisition? 300 into 700 plus 1%. 2,100,000. Total 8,000. Everyone getting 8,400. This is what? Short-term capital gain. So if this extra column was there in the question, no, then my final answer here would have been changed. How much this will become now? This will remain same. But in this, now the short-term gain will be added 8,400. So therefore, for previous year 25, 26, assessment year 26, 27, the taxable LTCG will be how much? Under section 112 will be same, no? 59,440. 59,440, and my taxable short-term capital gain, which was already 1,90,000, 1,99,000, 1,99,780. Yes or no? In that, I will have to add this 8,400 extra short-term gain. Yes or no? How much now? 2,08,180. Understanding? If they would have told me, in the same question, they would have told me that the remaining 300 shares are not sold with those 700 shares. They are sold separately on 26th of March for a separate selling price. Then one more extra column would have been added here, and in that column, my capital gain, short-term gain would have been 8,400, and in that case, my short-term gain would have been this much? No, my short-term gain would have been this much, 2,08,180. Got it, sir? Easy or difficult? Made easy. Okay. So this is the end of your basics. But wait, in basics now, in basics, two small things are to be done. One small thing, the discussion about cost of improvement. What? Cost of improvement. Okay, no? See, what is cost of improvement? Tell me. We have done so far everything. This 55 to AC, we are going to do after the discussion of cost of improvement. After the break, I am going to start with this. And this is very, very, very important. Okay. In the examination, if you are expecting questions on shares, no, expect 55 to AC to be there. And this is very interesting also. Okay. So right now, no, in capital gains chapter, our main discussion is revolving around shares. Understanding? So whenever the capital gains for shares is there, your calculations are going to be like this only. Okay? Understanding? So now pay attention. There is one long-term gain, 112A. With that, I'm going to discuss this. No, I'm going to discuss this after the break only. Okay? No? But first, let us discuss cost of improvement. See, from your capital gain, when you will calculate your capital gain, no, only cost of acquisition will not be reduced. Cost of improvement will also be reduced. So what is the meaning of cost of improvement? See, any capital expenditure, what did I say? Any capital expenditure which is incurred on or after 1st April 2001, due to which the value of your capital asset increases. So necessarily, all the capital expenditures can only be treated as cost of improvement. But because of that cost of capital expenditure, your assets value should increase. Because of incurring that expenditure, the value of your asset increases. Only then that capital expenditure will be known as cost of improvement. Now see, if the capital expenditure which increases the value of your asset, if that is incurred prior to 1st April 2001, no, you have to ignore it. That is not treated as cost of improvement. For that, we are not going to give you any deduction. We will consider only those capital expenditures which you have incurred on or after 1st April 2001. Now, what is the logic for that? But first of all, understand one thing. Do you have a capital asset? Yes or no? On that capital asset, are you incurring any capital expenditure? Yes. And that capital expenditure increases the value of your capital asset. Then the capital expenditure will be known as cost of improvement. You are going to get deduction of that only if you incur on or after 1st April 2001. Meaning any cost of improvement, even if it increases the value of your asset, if it is incurred prior to 1st April 2001, it will be ignored. It will be. What is the reason for that? First of all, understand the examples. Example of cost of improvement. See, this is my entire premises. I am constructing one floor on this premises. By constructing additional floor on the premises, meaning I am incurring cost of additions. Cost of. Because of this, don't you think that the area of my property will be increased? Instead of ground floor, now there will be a first floor also. Now, if I sell the property having only ground floor, the property can be sold for 50 lakhs. Now, if I construct one more floor, now if I sell the property, will I get only 50 lakhs or will I get more amount? Why? Because the area of the property got increased. And as a result of that, the value of the property also got increased. So the cost of addition, cost of construction of this first floor is nothing but cost of improvement. Understanding? For example, I have broken this wall. This entire wall I have broken and I have extended this entire premises. The cost of only this much area, small room, is only 30 lakhs. And if I break this wall and increase the area of my premises, then don't you think for the bigger premises, I will get more amount in the market? If the area is only 500 square feet, I break the wall, I do the extension work, yes or no? Due to that extension, the area of my property from 500 square feet, it increased to 700 square feet. 500 square feet premises I am selling for 30 lakhs. Will I sell the 700 square feet premises for 30 lakhs or more amount? How did my property become 700 square feet? I broke this wall, I did the extension work done, then from that extension work which I have done, from that, have I incurred some cost? Yes. Because of incurring that cost, my area of the premises got increased, and because of that, now this bigger premises can be sold for higher amount. Value increases, yes or no? And the cost which I have incurred, which increases the value of my premises, is nothing but cost of improvement. So any cost which you do, like cost of addition, cost of alteration, cost of extension, etc., are known as what? Cost of improvement. Any cost which you are incur on regular repairs, etc., which does not increase the value, is not your cost of improvement. For example, 2-3 tiles were broken. I got them repaired. Because of that, the value of my property will increase. So that is not cost of improvement. Cost of improvement means any capital expenditure because of which the value of my property increases. That is cost of improvement. For that you can take the deduction. Understanding? But that cost of improvement, if it is incurred prior to 1st April 2001, needs to be ignored. So first of all, normal expenses of current nature like repairs, etc., are not treated as cost of improvement, since these expenses does not increase the value of my capital asset. You have to ignore these expenses because they are not treated as cost of improvements. Because why? They are not increasing the value of my property. Then cost of addition, cost of alteration, etc., are known as my cost of improvements. Why? Because incurring these expenses will increase the value of my property. Yes or no? Now, any cost of improvement incurred prior to 1st April 2001 is not treated as cost of improvement only. I will ignore them. So, in order to treat any capital expenditure which increases the value of my asset, in order to treat that as my cost of improvement, it must be incurred on or after 1st April 2001. Yes or no? So any cost of improvement in case of assets acquired prior to 1st April 2001, the option to take the fair market. See, this is the logic given. Why that cost of improvement is ignored? I'll tell you. For example, a small timeline I am making in front of you. Okay, no? Assume that this is the timeline. This is my previous year. Previous year, 25, 26. Okay. In this year, I am transferring. This is the year in which I am transferring my asset. This is the year of transfer. Okay, no? So if in this year I am transferring an asset, that asset I acquired in, say for example, I acquired that asset in previous year, 2006-07. When did I acquire the asset? So this is the acquisition year. This is the acquisition year. In this year now, I acquired the asset. The cost of the asset was, example, 5 lakhs. Cost of the asset was 5 lakhs. Now this asset, as it is, what did I say? As it is, without any improvement, if I am selling this asset today, so I can transfer this asset. Okay, sorry. This is the transfer year. Okay, in this year I am able to sell it for a selling price of rupees, for example, 40 lakhs. How much? So asset I acquired without doing any improvements. If I am selling the asset today, so that same asset I can sell for 40 lakhs. Understanding? But what if I do some improvements? What if I do some improvements? After purchasing the asset, after acquiring the asset, in the previous year, 13-14. Which year? 13-14. I did some improvements in the asset, and the cost of improvement was incurred 2 lakh rupees. Now tell me, if I don't do this expense, then I can sell the same asset for 40 lakhs. Yes or no? Hello? But if I do this expense of improvement, if I incur this cost, will the value of my property increase? Will I sell it for 40 lakhs or more amount now? So I am able to sell the property for 45 lakhs. For example, this year I am selling the property for 45 lakhs. I am able to sell it for 45 lakhs because I have incurred this improvement. If this improvement would not have been incurred, definitely the selling price I would have received right now would have been less. So whatever selling price I am receiving right now, whatever amount I am receiving as a consideration for transferring my asset right now is this much because the asset was improved. If the asset was not improved, I would not have been able to receive this much amount. I would have received less amount. So right now I am receiving 45 lakhs because of that improvement. So do one thing, reduce that improvement cost also. We are going to allow that also. Because of this cost, the higher selling price is coming. No. So whenever you will calculate your capital gain, to calculate your capital gain from your net consideration, don't just reduce the cost of acquisition, also reduce the cost of improvement, because by incurring this cost of improvement, the value of your asset has increased, and as a result of that, you are getting this higher selling price. If you would not have incurred this amount, definitely the amount which you would have received right now would have been lower. So since you are getting a higher amount, why? Because the value of the property has increased, hence you are getting this higher amount, and that value of the property has been increased because of incurring this type of expenditure. So do one thing, by calculating the capital gain, take the deduction for this also. Understood or not? Understood or not? So tell me, is it a cost of improvement when it is incurred? On or after 1st April 2001 will be allowed as a deduction. So when I'll calculate my capital gain, what I'll do? I'll take the full value of consideration, 45 lakhs, minus minus transfer expense, will give me net consideration. Out of that net consideration, I will reduce cost of acquisition, I will reduce cost of improvement to calculate my capital gain. Easy or difficult? Now, pay attention. Second example, this is example 1. Now my second example is example number 2. In this example now, let's assume the same thing. Okay. I'm transferring my asset in the previous year 25, 26. I'm transferring the asset. Okay. Now this asset, no, sir, I bought this asset in 91, 92. Which year I bought? 91, 92, I acquired this asset. Asset acquired prior to 1st April 2001. I acquired the asset on 91, 92. How much cost? Example, the cost of acquisition of the asset, meaning actual cost. Actual cost at the time of acquisition. Actual cost was 1 lakh rupees. How much? So I acquired the asset for. Then I did some improvements also. Can I improve the asset? Okay, no? But let's now first ignore the improvement part. Okay. First of all, tell me, since the asset is acquired prior to 1st April, do I get that option? Option to take fair market value as on 1st April 2000. So let's take one example, that the fair market value as on 1st April 2000. This is my 1st April 2001. On this date, the fair market value of this asset is 1,50,000. How much is the fair market value of this asset? So since the asset was acquired prior to 1st April 2001, hello, I get the option under section 55 2B to take the actual cost or fair market value, whichever is. So which cost I will take? Tell me. That takes care of everything done prior to 1st April 2001. Whatever inflation has taken place from 91-92 to 2001 to, all that inflation is already covered in the fair market value. And for example, if any improvement is also done, will be taken care of by this fair market value only. Because if you incur some improvement in the year 95-96, in this year you have done some improvement. Okay, now tell me, by doing this improvement, the value of your asset has increased. So this fair market value will not remain 1,50,000, now it will increase. So fair market value of the asset which you have purchased will be different, and the fair market value of the improved asset will be higher. So as on 1st April 2001, whatever is the fair market value, don't you think this will be the fair market value of the improved asset? Because the improvement was already done prior to 1st April 2001. So this is not the fair market value of your asset which you originally acquired. This will be the fair market value of the improved asset, because improvement was already done prior to 1st April 2001. So if the improvement done was, the cost of improvement was 20,000. How much? 20,000. So now tell me, a fair market value will be 1,50,000 or will be higher? Now this will not be the fair market value of the asset which you originally acquired. This will be the fair market value of the asset which you acquired and improved. The fair market value of that asset is there. So now the fair market value will be how much? Example, it is 2 lakhs. How much? Don't you think? If we are giving you the option to take this fair market value, you would have taken this fair market value as the cost. That fair market value takes care of everything done prior to this. Meaning that the improvement done prior to 1st April 2001 is already considered in this fair market value. And you want the deduction for that cost of improvement separately. We are not going to allow. Only the cost of improvements which will be done on or after 1st April 2001 will be eligible for what? Deduction. Did you get the logic for that? Why that cost of improvement prior to 1st April 2001 is ignored? Yes or no? Why ignored? Because if cost of improvement is done prior to 1st April 2001, 100% my asset is acquired prior to 1st April 2001. How can I bloody incur a cost of improvement prior to 1st April 2001 if I have acquired the asset on or after 1st April 2001? I have acquired the asset in 2009 then. Can I do the improvement prior to 1st April 2001? No. I can do the cost of improvement on the asset prior to 1st April 2001 if I have acquired the asset prior to 1st April 2001, yes or no? So after acquiring my asset, only I can do the cost of improvement, yes or no? So when did I acquire the asset? Prior to 1st April 2001. In that case only it is possible that I would have done the cost of improvement prior to 1st April 2001. And if I have incurred the cost of improvement prior to 1st April 2001, which means my asset was acquired prior to 1st April 2001, for that asset I get the option to take the fair market value as on 1st April 2001. And don't you think this fair market value will cover everything happened prior to this date? Even the cost of improvements incurred prior to this date, prior to 1st April 2001, will be automatically taken care of by this fair market value. And we are going to give you the option to take this fair market value as your cost of acquisition. And if you are taking this fair market value, that means already the cost of improvement is considered in this fair market value, which you are already taking as a cost. Then why are you taking it as your cost of improvement separately? Will not be allowed. Understanding? Now for this asset, later on any cost of improvement is incurred. Now for example, in the year 2009-10, if some cost of improvement is incurred, hello, cost of improvement, the cost of improvement was, example, 50,000. How much? This cost of improvement we are going to allow you. Because this is what? Incurred on or after 1st April 2000. So now whenever you will calculate the capital gain, for example, the asset is transferred for selling price of the asset was 10 lakhs. How much? So this 10 lakh you are receiving because of this improvement only, no? If you would not have done this improvement, the selling price would have been lower. So while calculating your capital gains, also reduce this cost of improvement. So what will be your full value of consideration? 10 lakhs minus transfer expense, net consideration. What will be your cost of acquisition? What will be your cost of acquisition? 1 lakh or 2 lakh, whichever is, meaning this is already considered, no? So cost of acquisition will be 2 lakhs. Is there any cost of improvement? Yes, sir. This is also cost of improvement. This is also cost of improvement. Ignore this one and take the deduction only for this cost of improvement. Will you remember this? Everyone, why you have ignored this? Because the moment cost of acquisition you have taken, 1 lakh or 2 lakh, whichever is higher, in this 2 lakh, already this 20,000 has been taken care of. No need to take the deduction separately. We are not going to allow any deduction for this cost of improvement. Okay, after this, whatever cost of improvement is incurred, because of that, the value of your asset has increased, which you are receiving as a higher selling price, take the deduction of that cost of improvement. Yes or no? So this will be allowed? Yes. This will be allowed? Yes. Here, this or this, whichever is higher. Higher is how much? 2 lakhs. If 2 lakh is allowed as your cost, meaning you have to ignore this. If you ignore this, take only this cost of improvement. Done, sir? Everyone? Sure, no? So this is the end of our discussion. Cost of improvement. Okay? Now, while solving the question, no, be a little bit careful about these things. Any cost of improvement given in the question which is incurred prior to 1st April 2001, you ignore. Because in that case, you are taking the fair market value as on 1st April 2001 as your cost of acquisition. Definitely the asset would have been purchased prior to 1st April 2001. Any cost of improvement appearing in the question which is incurred on or after 1st April 2001, take that cost of improvement only. Understanding? Now, nobody has asked me that, sir, why this 1st April 2001 only? It could have been any other date also, no? Do you remember that cost inflation index table is there? For that a base year is selected. Base year is 2001-2. So one base year is selected as 2001-2. From there they have started notifying the cost inflation index. Hence the date 1st April 2001 is important. If they would have taken 2008-9 as a base year, if they would have taken 2008-9 as a base year for CII, cost inflation index, then this date 100% would have been 1st April 2008. In our times, no, when I was a student in intermediate and final, we had base year 1981-82. We had base year 1981-82. That year, in that time, indexation and everything used to happen. We had to remember the CII entire table also. What is the CII for 81-82? What is the CII for 82-83? We had to remember those CII numbers also. You all are very lucky that if indexation is applicable in your solution, they will definitely give you the CII in the question itself. You don't have to remember the cost inflation indices. Understanding? So with this, the discussion of entire calculation, how to calculate the capital gain, that is over. Okay? So basics are over. Basics are over. But in basics now, one important discussion, 55 subsection 2 clause AC, which defines the cost of a specific type of asset. That is remaining to be done, that we are going to do after the break. Okay, no? So take a break, 45 minutes. After the break we are meeting. and we'll finish that discussion also. Okay.